Hey everyone, it's Justin here, America's honest tax accountant from Number Crunch Nerds. So right down here we have Phil and Barbara Baker, and the couple is newly retired. Phil right here is 66 years old and Barbara is 62 years old. They need to make a tax planning decision for 2026 and they need your help. So here is the situation that they are dealing with. Okay, right down here in the family's regular brokerage account, not a retirement account. The couple purchased back in 2020 4,000 shares of XYZ stock. The cost per share was $34.81, leading to a cost basis in the position of $139,240. So now it's 2026 and they still have the same 4,000 shares of XYZ stock. The price of the shares has increased to $57.28 per share. And so the fair market value of the position now is $229,120. All right, now next year, meaning in 2027, the couple is already planning that both individuals will start collecting Social Security. Plus, Phil has a pension that will also kick in, and therefore the grand total of both of these items for 2027 is expected to be $98,693. That's for Social Security times 2 people, plus a pension times 1 person. So 2026, as it turns out, is a big year for the couple to make a tax planning decision, because at the moment they actually have very little income. In fact, all they currently have projected for 2026 is $12,000 of taxable interest income, plus $23,000 of non-qualified dividends. Now, the couple has also been projecting their RMDs using the personal tax planning template, and they have determined that they are going to consistently be in the 24% marginal bracket during the RMD years. So the decision that they're trying to make basically boils down to this. Barbara is getting a little bit concerned about the market right now. In addition to that, the last earnings release from XYZ company fell short of Q1 expectations. So Barbara's looking over at Phil right now and she says you need to sell or bump up the basis in that stock in 2026. That XYZ stock has had its run. And what's more, selling or bumping up that basis, that would be the best move for our taxes. Now Phil over here, he doesn't want to hear any of it. Are you crazy? He says to Barbara. XYZ company is just getting started. Plus, we're supposed to be doing Roth conversions. 2026 is the one year when our brackets are wide open. Well, says Barbara, that's exactly why you need to harvest that gain and bump up the basis. We already determined from the personal tax planning template that we're maxing out in the 24% bracket in RMDs, but the stock easily has another 40% to the upside, Phil retorts. The extra gain on the position will outweigh any tax benefits from harvesting now. Plus, we can convert from the 24% bracket into the 12% bracket in 2026 inside of our IRAs. Justin already said that converting from the 24% bracket into the 12% bracket is generally a no-brainer move. Well, first off, my dear, Barbara replies, you only think that XYZ has 40% to the upside because that's what you read in your Facebook chat group. What if XYZ turns to the downside? And secondly, Justin said to lay out our numbers inside the personal tax planning template and figure out what our best move is based on our specific facts and circumstances. He did not say to just blindly do conversions if we have better tax planning opportunities. Well, I'm not selling XYZ, Phil says in a huff. We're holding until at least 2027. Well, that's fine, Barbara says, but you still need to harvest that gain and bump up the basis. All right, so what do you folks think? Based on the fact pattern presented here, should the Baker family either option number 1, prioritize Roth IRA conversions in 2026, and get that money out of the 24% bracket in future RMD years, or option 2, should they focus on harvesting that capital gain in XYZ stock and bumping up the basis to fair market value. By the way, check out this review that I just received on the personal tax planning template program. It says, Justin, by the way, when I met with my CPA to go over my tax data, he was amazed that I understood so many of the new OBA rules and some other knowledge that I gained by using your personal tax planning template. Then he said that you, meaning this person, this member of the personal tax planning template program, you need to be teaching some tax classes to other CPAs in my office. That's right, my friends. This CPA asked this personal tax planning template member to teach his CPAs about all of the things that he learned inside the personal tax planning template program. Okay, let's crunch the numbers and see which strategy is going to be more beneficial to the family. Will it be focusing on Roth IRA conversions in 2026 or harvesting capital gain? And we're going to run through 4 scenarios on this tab. 2 of the scenarios will involve Phil being correct about XYZ stock having 40% to the upside, and the second 2 scenarios will be if Phil is wrong, and for that set of scenarios we're going to assume 40% to the downside on the XYZ shares, and we're going to see of all 4 scenarios which person, Phil or Barbara, has the most appropriate idea about how to do tax planning for 2026 to achieve the best outcome across all scenarios. All right, so let's set the stage here. We're going to first start with scenarios 1 and 2. In these scenarios, Phil is going to be right about the 40% to the upside. So right here for the capital gain calculation, we have the fair market value right now at $229,120. The cost basis, as we said earlier, is $139,240. That's going to lead to currently an unrecognized capital gain of $89,880. And so that we're comparing apples to apples across these different scenarios, we're going to assume that the amount of Roth conversion that the couple would consider doing in year 1 is going to be equal to the amount of capital gain right here that they could potentially harvest in year 1 as well. One last thing that I want to add before we get into the results of scenario 1 over here is that, remember, Phil said he doesn't want to sell this stock. But what he really means is he doesn't want to sell this stock and walk away. When you harvest capital gain, you can sell the stock in order to recognize the gain and then just purchase the stock right back at the same fair market value. Now, if you're thinking to yourself, wait a minute, isn't there some kind of tax problem with doing that? What you're thinking about is losses. That would be called a wash sale loss if there was a loss involved. If you sell a stock at a loss and then try to take the loss on your tax return, but you subsequently purchase the same stock back within the 30 days, you have what's called a wash sale loss, which is disallowed temporarily in the current year for tax purposes. But we're not talking about losses here. We're talking about a gain. There is nothing in the tax law to prevent you from selling a stock and recognizing a gain. And then if you choose to just purchase the stock right back at the same price, now your basis is effectively stepped up to the fair market value. Even though technically that's not really a step up in basis, effectively it really is, because you have just completed a transaction, recognized a gain, and if you buy it back, your basis is now what the purchase price was again, which is equal to the fair market value. And that is what Barbara is talking about, harvesting that gain. Even though Phil wants to stay in the position for another year, she means sell the stock and then buy it right back so we can recognize that gain and bump up the basis to fair market value. Okay, so with that in mind, let's go to scenario 1, and this one will be where Phil gets his way. In other words, the couple is going to do a Roth conversion in year 1, and then they will deal with selling the XYZ stock later in year 2, in this case 2027, and so we will deal with the tax consequences of that long-term capital gain or loss in year 2. Also in this scenario, one more time, Phil is right about the stock appreciating by 40% to the upside, and we're going to say that that happens by 2027 as well. Okay, so for year 1 income right here, the Social Security and pension income doesn't start until 2027, as we mentioned. So that's going to be 0 for year 1. The taxable taxable interest income we mentioned was $12,000. The non-qualified dividends are $23,000. And so in this scenario, Phil gets his way, as we said, and so the couple is going to do a Roth conversion. And as I also mentioned, we're going to set the amount equal to the amount of potential capital gain. So that would be a Roth conversion of $89,880. The standard deduction for 2026 for a married filing joint couple is $32,200. Phil happens to be over 65, so we'll throw in the additional senior deduction right there. And that leads to ordinary taxable income of $91,030. In this scenario, because Phil is getting his way, there will be no capital gain harvesting in year one, and therefore total taxable income is going to be $91,030. Now let's go to our brackets for a good 2026 refresher. The first $24,800 gets taxed at the 10% rate. That leads to $2,480 of tax. And then what is going to be in this cell right here? Let's double click on it. We have the total amount of ordinary income less the top of the previous bracket multiplied by the rate applicable to this next bracket, which is 12%. That leads to tax of $7,948. Now let's hop over here to year two. We now have the Social Security and pensions starting at $98,693. We're going to assume the interest and non-qualified dividends are the same. There will be no Roth conversion in 2027 in this fact pattern. For mathematical simplicity, we're just going to leave the standard deduction and the additional senior deduction the same. And so now we have $99,843 of ordinary taxable income. And then the next item is going to be the amount of capital gain that Phil is finally comfortable recognizing. That is going to be $181,528, and that is calculated right over here in this section. If I double click on this, we applied a 40% growth rate to the amount of the fair market value in year one. The cost basis right here of $139,240 remains the same, and so that leads to a taxable gain of $181,528. That's what this number right here represents, and total taxable income therefore is going to be $281,371. All right, going back over here to the year two tax, the first bracket works exactly the same way as the prior year. The second bracket, if I double click on it, works exactly the same way. We have the total amount of ordinary income. We subtract off the top of the previous bracket and multiply it by the rate applicable to the next bracket. That gives us $9,005 of tax. Now we have to come down here to the capital gain brackets. In year one, there was no capital gain. In year two, we have capital gain of $181,528. And for folks who have been keeping up on the channel, how much of that gets taxed in the 0% rate and how much of it gets taxed in the 15% rate? And the answer is, in this case, all of it is going to be taxed in the 15% rate. Why is that? Because capital gain is the top bucket. Remember, all other income items push capital gain higher up into the brackets. And so if we already have other income which exceeds the top of the first capital gain bracket, which we do in this case at $99,843 of ordinary income, that means that all of the capital gain has been pushed out of the 0% bracket and into the next bracket, which is 15%. So in this example, we're looking at $27,229 of long-term capital gain tax. And then if I double click on this number right here, I'm just adding up all the tax right here across the scenario. And the result across the entire analysis in scenario one is going to be $49,142 of total tax. Okay, now let's hop down here to scenario number two. In this one, Barbara is going to get her way, meaning they're going to harvest the capital gain. In this case, Phil is still going to be correct about the 40% upside to the stock, so they will harvest the long-term capital gain that Barbara wants in year one, and then they will do the Roth conversion that they are now not doing in year one in some future year. All right, let's run through the income for year one. So Social Security and pension is 0. Interest income is the same as above. Non-qualified dividends is the same as above. We're not doing a Roth conversion in year one because Barbara is getting her way. So that is going to be 0 on the Roth conversion. Standard deduction and senior deduction are the same. That leads to ordinary taxable income of $1,000 $1,150. That $1,150 of ordinary taxable income will be taxed at the 10% rate, leading to ordinary income tax of $115. Then on the next line, we are going to harvest that capital gain, which is now equal to $89,880. Again, we are recognizing this gain right here, and then we're assuming that Phil is just going to repurchase the stock at $229,120, and that amount right there will become his basis in the new position. Okay, now coming down here to the long-term capital gain brackets. Of this $89,880, how much is going to be taxed in the 0% rate, and how much is going to be taxed in the 15% rate? And the answer in this case is that all of it is going to be taxed in the 0% rate. Why is that? Because if income does not exceed the top of the bracket right here, which it does not in this case, then any capital gain which exists, which is part of this total income number, will be taxed in the first capital gain bracket, or the 0 bracket. Now coming over here to the income for year 2, this is the same as above, this is the same, this is the same, this is the same, this is the same, and this $99,843 is the same. Therefore, if we look over here, the $2,480 in the 10% bracket is the same, and the $9,005 in the 12% bracket is also the same. And this time, going down here, the amount of capital gain recognized in year 2 is going to be $91,648. How did we come up with this number? Well, we did that right up here in this calculation. Remember, the fair market value after the 40% upside is going to be $327.86, but the cost basis in this example is now going to be this $229,120, which is the amount paid by Phil when he repurchased the position after harvesting the gain. Therefore, the $327.68 minus the $229,120 is $91,648. That's the $91,648 down here. And which brackets in the capital gain brackets is this number going to be taxed in? And the answer again is all of it will be taxed in the 15% bracket, because the amount of ordinary income at $99,843 is already above the top of the 0% capital gain bracket. Therefore, it pushes the entire amount of capital gain up into 15%. So we have $13,747 of long-term capital gain tax. Okay, and now what is the final thing we have to consider in scenario 2 in order to make this an apples to apples comparison? And the answer is, at some point the couple's going to have to complete this Roth IRA conversion, or they're just going to have to take the money out in the form of an RMD, or however the money comes out of that traditional IRA. But we already established in the fact pattern that they are going to be in that 24% marginal rate for that entire time. And so if I double click on this cell right here, what we're saying is that in some future year, we are going to have to recognize ordinary income tax on this conversion that we did not do in this fact pattern yet, and that tax will be recognized at 24%. So that's a grand total tax of $21,571. If I go down here and double click on this, we are adding up all of the ordinary income tax plus all of the long-term capital gain tax, giving a scenario 2 grand total tax of $46,919. And so now comparing the results of $46,919 of tax in this scenario versus $49,142 in this scenario, Barbara was correct. It was more beneficial to harvest that long-term capital gain in year 1 and therefore postpone the Roth IRA conversion to another year versus Phil's idea of accelerating the Roth conversion into year 1 and pushing off the long-term capital gain into the future. Barbara's idea resulted in $2,223 of less tax over the life of that fact pattern. And to get a better understanding of why, let's go down here to this reconciliation between scenario 1 versus scenario 2. Right here we have the Roth IRA conversion income of $89,880. There was other year 1 ordinary income in this example of $1,150. The reason I mention that is because this item is taking up room in the first bracket, or the 10% bracket. So if we subtract it out from the amount of Roth conversion income, that leaves $88,730, which can potentially fill up the lower brackets. However, the amount of room available in the 10% bracket was only $23,650. That's going to be the $24,800 top of the bracket right here, less the $1,000 $23,150 of other ordinary income, which was already in the bracket. So $23,650 of the Roth conversion income ended up in the 10% bracket. And what I want you to start thinking about when it comes to tax planning is tax rate differentials. So basically what we have here is an amount that would have been taxed in the 24% bracket in RMD territory. We moved it down into the 10% bracket through a Roth conversion, and that leads to a 14% differential. Then we had $66,230 left of Roth IRA conversion income. We moved that down from the 24% bracket into the 12% bracket, leading to a 12% differential. And so when we multiply this $23,650 by the 14% differential and this $66,230 by the 12% differential, we get a grand total tax savings of $11,259 on the Roth conversion. However, in this fact pattern, we were able to obtain something even better with respect to the capital gain. We moved the capital gain out of the 15% preferential bracket and into the 0% preferential bracket under Barbara's guidance. Therefore, we ended up with a 15% differential. And when we multiply the 15% differential by the amount of the capital gain, it leads to $13,482 of tax savings. And that is why $13,482 less this $11,259, resulting in less tax in Barbara's scenario to the tune of $2,223. Okay, now let's hop down here to scenario number 3. In this one, Phil is going to get his way, meaning they're going to do a Roth IRA conversion in year 1. However, he is also wrong about the 40% upside. For this example, we're going to assume 40% to the downside on the movement of the stock between 2026 and 2027. And so the couple is going to convert in year 1, and then they will recognize, in this case, it's going to be a long-term capital loss in year 2. If we look right here, in year 1, the fair market value is the same, the cost basis is the same, and the gain would have been the same if the couple decided to harvest it. However, in year number 2, assuming no harvesting in year number 1, a 40% decrease in the stock price would bring the fair market value down from $229,120 to $137,472. The cost basis, of course, remains the same, leading to a long-term capital loss of $1,768. So now let's run through year 1's income again. All of these items are going to be exactly the same as in scenario 1. So you can see the year 1 tax right here is $2,480 plus $7,948. If I scroll back up here to scenario 1, you can see that's exactly the same result we got right there. The reason it's the same one more time is because they're going to do a Roth IRA conversion, and they're not going to do any capital gain or loss harvesting in year 1. However, when we get to year 2, they are going to sell the position in XYZ stock. Everything else in the income section is identical except for one thing, and that's the $1,768 of long-term capital loss. Remember that regardless of whether loss is long-term or short-term, it will be taken on the tax return as ordinary income up to $3,000 annually. So in this case, the amount is less than $3,000, so we can take the full amount of the capital loss right here, and therefore the major differences between scenario 3 and scenario 1 with respect to year number 2 is going to be, instead of having that larger long-term capital gain right here, we're simply going to have this long-term capital loss. And you can see the numbers I'm talking about right up here in scenario 1. That was the long-term capital gain, and there was no capital loss in that scenario. And so coming back down here, it's very simple. This $98,075 will be applied to the ordinary income tax brackets. The first $24,800 will fall into the 10% bracket, and the remainder will fall into the 12% bracket. There is no capital gain in this particular fact pattern, and therefore the grand total tax for scenario number 3 is going to be $21,701. Okay, finally, let's hop down here to scenario number 4. This time Barbara gets her way, which means they're going to harvest the long-term capital gain in year 1. Phil is also wrong about the 40% upside. It's going to be the 40% downside on the stock again. And so first, they're going to harvest the long-term capital gain in year 1, and then they will do their conversion in some future year. Okay, starting with year 1 income, everything right here is going to be identical to scenario 2 for year number 1. As you recall, in scenario number 2, we had $115 of ordinary income tax and $0 of long-term capital gain tax. Going back up here to scenario 2, we can confirm that right here in this column. Now, before continuing, let's go right over here to the year 2 fact pattern, assuming that we did harvest in year 1, which is what we're doing in scenario 4. In that case, the fair market value after 40% to the downside is going to be $137,472. That's no different than right over here. However, the cost basis is now going to be $229,120, which is what this fair market value was when Phil repurchased the shares after harvesting this capital gain. And so with this being the fair market value and that being the cost basis, we're now looking at a long-term capital loss of $91,648. Okay, so coming down here to year 2 income, this is the same, this is the same, this is the same. This item is different. We can use up $3,000 of loss against ordinary income. This is the same, this is the same. And so this is basically the same except for that $3,000 right there. As you can see, this $96,843 of ordinary taxable income results in $2,480 at the 10% rate plus $8,645 at the 12% rate. The couple still has to do their Roth conversion in some future year. That is going to result in the same amount of tax as we saw in scenario 2. We're simply taking the amount of conversion that they did not do in year 1 and multiplying that by the 24% marginal rate. And so the only remaining difference in this case is going to be this item right here. This item is going to be the total long-term capital loss that they generated in this fact pattern. This is a negative number right here, so I'm just going to add $3,000 to it in order to reduce it. That $3,000 is the amount of capital loss that we used up already right here in year 2. And then I'm going to multiply that by the 24% rate. Okay, why am I multiplying this by the 24% rate? And the answer is because we said for purposes of the Roth conversion, for purposes of any ordinary income item, that this couple would be in the 24% marginal rate out into perpetuity after the current year when they're trying to do their tax planning. And so the value of this loss, because it will go against ordinary income in future years, the value of it is whatever the marginal rate is going to be. And so what Barbara did right here with this capital gain harvesting strategy is that she looked at the value right here in year 1 and she said, you know what, if Phil is wrong and actually this stock moves to the downside, if we don't harvest this capital gain, what happens right here is just basically that all of this capital gain just goes down essentially to zero. And so we're saving, quote unquote, at the 15% rate. Follow what I'm saying? The tax savings of watching this gain disappear through the attrition of this fair market value is only saving you tax at a 15% rate because you're just reducing the amount of gain that is there. On the other hand, if you harvest this now and you bump the basis up to here, then if the price were to erode going forward as it has done in scenario 4, we're creating a loss that can go against ordinary income now. And so the tax value of this going away is no longer at the 15% rate. The tax value of this going away is at the marginal rate, which in this case is 24%. And so to summarize, by harvesting that gain, Barbara was able to switch the character of any potential loss from essentially a 15% rate item to a marginal rate item, or in this case, a 24% rate item. And because of that savings at the marginal rate, granted that's only at $3,000 per year over time, but it is still at the marginal rate. When we add up all of these items here, you can see that the scenario 4 grand total tax is $11,536, which if we compare that to scenario 2, where Phil was pushing for the Roth conversion in year 1, Barbara's strategy saved $10,165 of tax on the possibility that the XYZ stock would move to the downside. And so you can see that in both cases, Barbara was right. Whether the stock went up or down, Barbara was identifying the tax rate differentials, saying that this right here at the 15% differential was more valuable than these 14 and 12% differentials. And then conversely down here, if there was a loss on the position, the value of getting a 24% deduction on that loss, as opposed to just having the gain trickle away at 15%, that differential caused the capital gain harvesting in this scenario to remain the most valuable option as compared to the Roth conversion for this specific fact pattern that we've laid out. Now, there is another reconciliation down here between scenarios 3 and 4, which gets you all the way down to the 10,165 from right up here. I am going to upload this Let's Crunch the Numbers work paper into the members area for the personal tax planning template. For folks that want to dig through these numbers a little bit more, go into the formulas and see what's happening, or perhaps even employ this worksheet for a strategy that you may have coming up. So if you're a member of the personal tax planning template program, feel free to log in and you can download this worksheet. By the way, if you are just discovering the Number Crunch Nerds YouTube channel, or have been wondering if the personal tax planning template is right for you, check out some of these recent reviews from members of the program. Right down here, Justin, thank you for the tremendous work that you do. I've learned a great deal from your content, and I appreciate that you present information factually and without spin. Your clear explanations, and especially your outstanding Excel model, that means the personal tax planning template, have allowed me to test scenarios with my own data and finally get the clarity that I have been searching for. It continues, where I work, I have become the person colleagues ask about retirement planning. Over the past year, I have been trying to determine whether Roth conversions made sense to me. I spent considerable time and money consulting with a certified financial advisor, yet still didn't get the answers that I needed. Your personal tax planning template is what finally allowed me to understand my own numbers. And then right down here, I am a practicing CPA for almost 50 years. I am 72 years old. I am still practicing, and I have been watching Justin and his Number Crunch Nerds for over 2 years on YouTube. It's amazing how Justin finds the time to create these wonderful spreadsheets and charge what I consider to be a bargain basement price. In addition, it is great that the spreadsheets and calculations are ready to use, and it saves me tons of hours if I have to create worksheets myself. You cannot find similar worksheets anywhere else. I encourage any tax professional to view his videos, as there is content I cannot get anywhere else, including in seminars or webinars where I'm paying hundreds of dollars. And then right down here from the H&R blockheads, it says, "Hi Justin, I appreciate all you do and have saved a certain amount of money in taxes just this year by double checking our tax person at H&R Block with the numbers in my personal tax planning template. After pointing out the issue, he admitted that the software he was using did not bring over the correct numbers to the 1040. By the way, do you know how many of my customers are CPAs, financial advisors, attorneys, or professors at some of America's largest institutions? There are more than 300 in the program that I am aware of. There could be more, but I'm only aware of the ones that communicate with me through their employer's email domain, and so you can see that they are either CPAs, financial advisors, attorneys, or professors. In other words, some of the very folks that you go to for financial advice are using my personal tax planning template program either for their own tax planning or as part of tax planning services that they are providing to their clients. Why has the personal tax planning template program been so successful with both ordinary folks as well as industry professionals? And I believe the answer is because Number Crunch Nerds and the personal tax planning template program is the one place out there where you can actually learn tax for real by the numbers. No more talking about it, no more thinking about it, no more fluff. I pull back the curtain on every single tax calculation. Gone are the days of those black box calculations that give you answers for which you have absolutely no idea how those answers, strategies, and ideas were generated. You want to know how valuable the personal tax planning template is? Divide the cost of the program by your marginal tax rate. I can see a lot of light bulbs going off right now. The result of that calculation is all that you need to get across the tax line at a lower rate for the program program to pay for itself. You have many hundreds of thousands or even millions of dollars sitting untaxed in traditional IRAs right now. Between failing to plan for RMDs, miscalculating conversions, getting hammered by widow's penalty, going over the IRMA cliff, getting dinged for underpaid estimated taxes, not understanding the annualized income installment method, incorrectly timing capital gain harvesting, H&R Block miscalculating your tax return, financial advisors who won't give you the answers you need and still cost thousands of dollars, and of course those pesky IRS notices in the mail related to it all. Uncle Sam is salivating over the fact that you don't understand taxes. Just let the chips fall where they may, he says. RMD schmarmd. Don't even worry about it. Just go have a couple of bellinis on the beach. Imagine letting tens of thousands of dollars or more slip right through your fingers and into the hands of the government during your silver years because you won't take the time to actually learn how taxes work. That is what Uncle Sam is counting on, and I guarantee you there are many, many, many Americans out there that will not let him down. But if you're ready to finally learn, hop into the Personal Tax Planning Template program today and join the nearly 10,000 members who have figured out how to save their families 5 to 6 figures in taxes over the course of their retirement years simply by learning how to create a tax plan where you can actually see how every single number impacts your lifetime effective tax rate. You can join the Personal Tax Planning Template program with lifetime access for a one-time access fee at the link in the description below this video on YouTube. And so that's going to be it for today's video. Thanks everyone for watching, and I look forward to seeing you inside the program.